Welcome to a new deep dive. Today we're plunging into the latest economic and market news, really pulling back the curtain on what's driving things and what it means for you.
Exactly.
Our mission, as always, is to turn that stack of updates into clear insights. We're covering, Tuesday, September 9th through Monday the 15th.
Right.
And we've got this powerful dual theme today. Don't fight the Fed. Don't fight AI. Almost contradictory, right?
It really is. Let's get into it.
Okay, let's unpack this and see what's really happening. Let's start with the big economic news. Inflation. Always top of mind.
Always.
We got two key indicators this week, and they seemed, a bit different. Wednesday, PPI Producer Price Index.
Wholesale prices.
Came in at minus 0.1%.
Oh.
Much lower than the plus 0.3% expected, and way down from plus 0.9% before. Sounds good, right? Maybe disinflation.
On the surface, yeah. Looks like good news.
But then Thursday, CPI Consumer Price Index landed at plus 0.4%,
Well,
a little hotter than the plus 0.3% expected.
right.
So you see these two things, and what's the real takeaway here? Especially thinking about the Fed.
Yeah, that's a great point. It's fascinating because while PPI was lower, it's known for being, pretty volatile, swings around a lot.
Okay.
So that negative print didn't shock the market too much. But the CPI being a bit hotter, interestingly, that didn't move markets much either.
Why not?
Because it was still seen as in line enough to guarantee that Fed rate cut everyone's expecting this week.
Okay. So
Yeah.
the market's just focused on the cut.
Seems like it. And that shows maybe a bit of vulnerability, right? This strong belief in a dovish Fed, maybe ignoring some data inconsistencies. Because if you zoom out, the real concern is core CPI. Strip out food and energy. It's been above the Fed's 2% target since, early 2021?
Wow, that long?
Yeah. And now it's had its second month in a row above 3%, highest since February. So inflation, despite some decent headlines, it's far from beaten.
So it seems like controlling inflation is taking a backseat.
It really looks like it's playing second fiddle right now to the Fed's other mandate, maximum sustainable employment, which brings us neatly to the jobs picture.
Right. And that employment mandate, the numbers there were really eye-opening.
Yeah.
Challenging that strong labor market story.
Definitely.
This week's jobless claims, for instance, highest in nearly 4 years.
Yeah, I saw that.
But here's the kicker, and maybe more worrying. The Bureau of Labor Statistics announced this huge revision. Payroll numbers revised down by, get this, 911,000, a record, for the year ending March 2025.
It's staggering.
That basically cuts the average monthly job gains in half for that whole period. What's behind a revision that massive? How does that change things?
It's incredibly significant. And honestly, it makes that sticky inflation we just talked about even more worrisome.
What does that weaker job picture mean?
Well, potentially less wage growth down the line, maybe less job security than the headline suggested just a bit ago.
Okay, so these big shifts, sticky inflation, huge job revisions, they must be affecting how people feel, right?
You'd think so.
Friday, we got the University of Michigan consumer sentiment number, 55.4. Lower than the 58 expected, lower than prior.
Yeah, a noticeable drop.
That's a clear signal of falling confidence.
A drop like that often means people pull back on discretionary spending. Big stuff like cars, home projects.
Even smaller things.
Even smaller things, yeah. Eating out, maybe delaying certain services. It's likely a mix of that job insecurity we just mentioned, plus that persistent inflation eating away at budgets.
Makes sense. Your dollar doesn't go as far. You worry about your job. You get cautious.
Exactly. And tomorrow's retail sales report, Tuesday's report, that'll be critical. We'll see if this feeling is turning into actual changes in spending. Is the consumer really starting to tighten the belt? That's key.
Definitely one to watch. Okay, let's pivot to maybe the biggest event this week. The Fed meeting on Wednesday. Rate decision time.
The main event.
And the market seems utterly convinced. Probability of a September cut. Still 100%.
Nailed on, apparently.
Most expected. 25 basis points, though a tiny fraction like 4% are betting on 50. Given everything we just discussed, sticky inflation, weakening jobs, why is the market so dead certain on a cut? What's that tell us about investor thinking right now?
That really is the million-dollar question, isn't it? And it goes straight to that don't fight the Fed idea.
Right.
The conviction comes from, a few things. First, those weaker job numbers, especially the huge revision, give the Fed cover to ease. They can frame it as supporting the labor market.
Okay, makes sense.
Second, there's this narrative now that the Fed has to cut to avoid a worse slowdown, almost no matter what inflation's doing.
Interesting.
But here's the twist. What about the Fed itself? They're not all on the same page. Markets are going to be watching the votes very closely. It's expected to be an unusually divided decision.
So different opinions within the Fed.
Absolutely. We think some members, the doves, might vote for 50 basis points, most probably for 25, but some hawks. They might vote for no cut at all, signaling they're still worried about inflation.
That division could spook markets a bit.
It could introduce some uncertainty, definitely. Looking further out for the rest of 2025, the odds of more cuts, like 50 basis points or more total, are still sky high at 98%. And most, 73%, expect 75 basis points or more in cuts.
Okay, let's switch gears to the markets themselves. What a week for U.S. stocks.
Record highs everywhere, it seemed.
S&P 500, growth stocks, the NASDAQ all closed at records today. It really feels like it's all about those Fed rate cut expectations, doesn't it?
That's a huge part of it, absolutely. That's the don't fight the Fed side, but it's only half the story.
Oh, what's the other half?
The other half is don't fight AI. Stocks, especially tech, got another massive boost from strong earnings, and it was all driven by artificial intelligence.
The AI factor.
Huge factor. Look at Oracle. Their cloud revenue is set to explode. They just announced a massive $300 billion deal to supply OpenAI with data centers.
$300 billion. Wow.
It's enormous. It's not just software hype. It's the actual infrastructure build out. It's so big. Larry Ellison, Oracle's founder, is apparently neck and neck with Elon Musk for world's richest person now.
Incredible. That shows the scale of this AI impact.
It really does. It highlights the massive capital pouring into AI infrastructure and how that ripples through tech chips, cloud, everything. For many investors, this isn't just hype. It feels like a fundamental shift.
And we saw that with the performance numbers, right? Really underscores that tech and growth lead.
Absolutely.
Large caps up 1.8% for the week. Small caps only 0.4%. Growth stocks surged 2.7%. Value just 0.5%. And the NASDAQ up 2.5%. Clear picture. Growth and tech pulling everything higher.
While the numbers look great, there's growing concern about valuations, especially how concentrated the rally is in just a few mega cap tech names.
Right. The same few stocks driving everything.
Exactly. Yahoo Finance noted today the mix of sticky inflation, weakening jobs data, and lofty valuations has sharpened focus on the rally's vulnerabilities, particularly its reliance on a narrow band of mega cap tech stocks. So for now, yes, dovish Fed hopes plus strong AI earnings equals higher markets, and FOMA is pouring fuel on that fire.
But FOMA can be dangerous.
Very. It's emotional. We've seen it before. .com bubble, you name it. The risk is when fundamentals get ignored because everyone's just chasing momentum. Right now, AI earnings are providing some fundamental support, but the momentum itself is powerful.
Okay, moving beyond stocks, gold hit another record high today too, up 1.2% for the week. What's driving gold when stocks are also flying? Is it just safety?
It's mostly tied to the U.S. dollar. Or rather, how weak the dollar's been.
Oh, right.
Through August, this has been the dollar's third worst year in the last 60, or since 1986.
Wow.
And a weaker dollar usually boosts gold, makes it cheaper in other currencies, pushes up demand. But there's something deeper happening too.
What's that?
Central banks, foreign central banks. Given the weak dollar, geopolitics, whatever, they're favoring gold over U.S. treasuries more and more.
Really?
Yeah. Their gold holdings actually topped their U.S. Treasury holdings for the first time since 1996.
First time since 96. That's a huge shift.
It's a major strategic shift, not just a short-term thing. It signals maybe a longer-term trend, this de-dollarization idea, and a broader rethink about reserve assets globally.
Fascinating. And what about world markets generally, following the U.S. lead?
Pretty much, yeah. Had a strong week, catching those U.S. tailwinds. Developed markets up 1.0%, hit a record today too. Emerging markets surged 3.4%.
Japan's still doing well.
Japan continues to shine, up 2.6%, another record today, crossed 44,000 last Thursday for the first time. And finally, bonds were up slightly. Yield on the 10-year Treasury fell just a tiny bit, 1.2 basis points.
Didn't it dip lower during the week?
It did, yeah. Intraday last Thursday, it dipped below 4% for the first time in 5 months. That drop in yields shows bond investors are also pricing in rate cuts, maybe slower growth. It's an interesting counterpoint to the stock market's optimism.
Okay, so pulling it all together, what does this mean for you listening? We've seen these powerful forces. A Fed expected to cut, AI excitement driving markets higher. That's our theme. Don't fight the Fed, don't fight AI.
Right. Those are the dominant narratives.
But digging deeper, we also found those currents underneath. inflation that's still sticky, jobs data looking weaker than we thought, and worries about valuations being so concentrated.
Exactly.
So hopefully you're now better equipped with the key insights from the week, seeing beyond just the headlines. Thanks for joining us on this deep dive. Until next time, keep learning, keep questioning, and keep exploring.